Hello, I'm Warren Robbins of Medident FS. I'm an income protection specialist for dentists and medical doctors. Today's topic is important tips on setting up your dentist income protection. As a dentist, it makes great sense to have income protection insurance, but making sure that it's set up correctly is more complicated than it might initially seem. So here's a few tips. How much cover should you take? You would certainly want enough cover to pay all of your essential outgoings, but if you'd also like to be able to continue with some leisure activities, if you're unable to work, it would be sensible to include an amount for this. The other element that you should also consider is often overlooked. If you would still want to retire with a reasonable lifestyle, even in the event of being unable to work for a long period, it would be prudent to also include an amount to contribute towards your retirement plans. Because there are limits on how much cover you can qualify for, which are based on your earnings, you need to ensure that the amount of cover that you want is actually available to you before you take out a policy. Okay, how long should you take your policy to run for? This is something that is surprisingly easy to get wrong. The typical arrangement is to take the policy to your planned retirement age, and superficially, this seems like a perfectly reasonable idea, until you think through the consequences of being unable to work for an extended period. Most dentists look to retire as soon as it's financially possible, but that intended retirement age is normally based on earning their full income as a working dentist. So, in the event that your only income was provided by claiming on your income protection policy, you would not accumulate enough money by your planned retirement age to fund the retirement lifestyle that you planned. So, running the policy term past your planned retirement age would provide additional years to accumulate that wealth and pay for the retirement that you want. And if you reach your planned retirement age with no issues, you just cancel your income protection policy at that point. Next, how long should you choose for your deferred period? Well, there are two important considerations here. The obvious one is, how long would you be prepared to wait before receiving a payout if you're unable to work? And the second is the huge impact on the cost of different waiting periods. It would not be unusual for day one policy to cost 5 times as much as a policy with a 3-month waiting period. So being covered for taking a week or two off when you have something like flu, in reality, is incredibly expensive. Now, this won't be obvious from insurer documents, so to fully understand why, watch my video on the financial impact of different deferred periods on income protection costs. Should you index link your cover amount? The answer to this is generally yes. Just 10 years of average cost of living increases reduces the value of a fixed amount of cover by almost 30%. You do need to be aware that if you take out the maximum amount of cover available to you, if your earnings don't increase, the annual cover increase might leave you unable to claim your full amount of cover. What type of premium should you take? Well, the 3 choices are guaranteed, reviewable, or age-based. Unless you like nasty surprises, you should go with guaranteed premiums every time. This won't stop your premiums increasing as you take additional cover each year, but it will fix the cost of any cover once you've taken it out. With reviewable premiums, the cost can increase not just when you take additional cover, but also for the cover you already have in place, which can get, and frequently does get, extremely expensive. Age-based premiums typically start off cheaper than guaranteed or reviewable, but will be expected to cost more than either over the policy term, so generally worth avoiding if at all possible. Now, which occupation class should you take? This is an easy one. You should always take an income protection policy that offers own occupation cover, as this is the only type that will pay out if you're unable to do the material duties of your role as a dentist. Now, the final thing to think about isn't really part of setting up your policy, but it's critically important if you work through a limited company rather than as a sole trader. The maximum amount of cover offered by insurers is based on various components of your earnings, and which components are included varies by insurer. Most insurers only look at salary and dividends and ignore the business profit, but a few insurers, not just Dentist Provident, will consider salary and business profit, which is typically a much higher figure, so allowing for a much higher level of cover. So if you work through a limited company, it's a really good idea to get expert income protection advice. Thanks for watching. I'm Warren Robbins of Medident FS, the income protection specialist for dentists and doctors.